Stronger US wage data adds to fears the Fed will have to hold rates high for longer. Core inflation progress in Europe supports a June cut by the ECB. China's economy strengthens, and weak Australian retail sales cause a rethink on the RBA's rate track. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, after we looked at Australia's slump in consumer confidence, ANZ Economist Miles Workman in New Zealand says it's not getting much better there either.
Perhaps the consumer does need a bit of a hug, because when you look at some of the data, I mean, real incomes are poised to grow, obviously, as inflation slows. But the outlook right now is one of a loosening labour market and a rising unemployment rate.
But first, in 5 and 5 with ANZ, US Treasury yields are up 4 to 5 basis points this morning, while the S&P 500 is down 0.8%. On fears, the Federal Reserve may hold rates high for longer. The US Employment Cost Index rose 1.2% in the first quarter. That was higher than expected, 1%. This overshadowed weaker US consumer confidence data. Meanwhile, in Europe, GDP rose 0.3% in the first quarter, beating expectations and showing the European economy out of a technical recession. Annual inflation held at 2.4% in April. ANZ head of G3 Economics, Brian Martin, says that supports the ECB. And the Bank of Japan's accounts suggest a 5.5 trillion yen intervention took place on Monday. Dollar yen currently up 0.8% at 157.6 yen at 4 a.m. Sydney-Melbourne time. All eyes are now on the Fed commentary tomorrow. Brian expects Chair Jerome Powell to stress a resolve to return inflation to target and that the FOMC can be patient.
The FOMC has guided more hawkishly recently, given the little slip that we've seen in inflation. It mightn't be big in terms of missing by 0.1 or 0.2 in a month, but nonetheless, it is a miss, and the central bank really has to garner confidence amongst US citizens and financial markets that it is resolute in its determination to bring inflation back to target.
Number 2, the Aussie and Kiwi dollars are down 1.2% at 4 a.m. Sydney-Melbourne time at 64.89 and 59.06 US cents respectively, thanks to a firmer US dollar overnight, but also following weak Australian March retail sales figures. They fell 0.4% versus expectations for a 0.2% rise. ANZ economist Maddie Dunk says the weakness caused traders to partly unwind bets that the RBA might hike in November after last week's strong CPI.
Just highlights the uncertainty about what's going to happen with rates at the moment. We saw that last week markets really changed their tune and were expecting that the RBA would start hiking rates. Now, some of that has unwound following this weak data, but, I think the onus will really be on that employment data that we get next week.
Number 3, Chinese manufacturing continued to expand in April, with the official PMI reading of 50.4, slightly above expectations. ANZ senior China strategist Zhao Pangjing says strong export orders and new orders are offsetting a still weak property sector.
The data confirmed a steady growth momentum for China. I expect the policy tone will remain unchanged going forward. The policy side, we expect the policymakers to have new stimulus on property sector only.
Number 4, Taiwan's GDP rose 6.5% in the March quarter from a year ago. That was ahead of expectations. ANZ Chief Economist for Greater China, Raymond Yung, says surging exports of AI chips mean the data reflects US economic strength.
The impact of this number is less about domestic interest rate policy of the Taiwan's central bank, the CBC, but I think perhaps they are not very worried about the currency stability at the moment. But the near-term focus in the domestic economy is inflation. And that's why we had a surprising interest rate hike in the first quarter. So I would focus more on the CPI figures in the forthcoming months, not the growth figure.
Number 5, ANZ's Business Outlook survey of business confidence for New Zealand found another fall in April. ANZ economist Susan Kilsby says there were mixed messages for the Reserve Bank of New Zealand.
We have seen a real turn in the employment expectations. So firms are expecting to take on less people going forward, and as that sort of labour market recorrects, you would expect to start to see a little bit of easing in the wage pressures as well. So things are starting to turn, but we've still got some way to go before I think the Reserve Bank will be seeing all the signs that they need to.
Susan Kilsby there. Now, after looking into Australia's dire consumer confidence earlier this week, in today's bonus deep dive interview, ANZ senior economist Miles Workman explains how in New Zealand the situation is worsening too.
When you look at the details of the consumer survey, it is the forward-looking components of the survey that really did deteriorate in the month of April. So that's whether or not consumers are going to be better off or think they're going to be better off this time next year, or whether it's the economy's 12-month or 5-year outlook. That's where we really saw the weakness in the survey in the month of April.
Because there was an improvement in late 2023, and then it seemed to fall off a bit of a cliff through March and April. I know that the headlines on GDP weren't friendly, but do you think that's the main reason, or is there something else going on?
Yes, well, I think there's lots of moving parts. The other part to consider here, I think, is that the fact CPI inflation is proving sticky, and perhaps consumers are coming to the realisation that interest rate cuts from the Reserve Bank could be a little bit further down the track than they previously thought. Ultimately, the Reserve Bank's not going to be in any position to cut interest rates so long as CPI inflation is looking like it's going to be above target, and that's what the recent data have been telling us. So, yes, I think there is also a component here that the consumer base is coming to terms with the fact that interest rates may have to be a bit higher for longer.
Interesting, the differences by region in New Zealand. For an international audience, could you talk about what's going on between Wellington, the capital, and the rest of the country?
Yes, well, pessimism was certainly standing out in the month of April in Wellington. It was the most pessimistic region of them all. It has the lowest inflation expectations as well, suggesting that, consumers in the Wellington region are pretty downbeat. And we think that's tied quite closely to the fact that the government is planning on cutting spending to pay for these tax cuts that they've promised. So while consumers will benefit from tax cuts across the country, Wellington is more exposed to these spending reductions, which will clearly impact the number of people employed by the government.
There has been a correlation, at least, between intentions to, or views about a good time to buy a major household item versus retail sales, and it was quite a close correlation up until COVID. But there seems to have been a separation that's broken out there.
Yeah, well, I think the first thing to note is that this indicator has certainly been pointing to very, very weak retail trade activity. So this is when we ask whether or not a consumer thinks it's a good time to buy a major household item. And yes, previously that has correlated very closely with retail trade activity. More recently, though, there has been a bit of a gap diverge. Now, that gap probably has a lot to do with very high CPI inflation. Certainly would be a driver across many consumers if they're answering this question, whether or not it's a good time to buy. To the extent that there's signal here, well, for retailers at least, this does look quite soft, because if inflation has been driving some of this pessimism, but that pessimism is deteriorating while CPI is slowing, then that sends a particularly weak signal for retail trade activity going forward.
Miles Workman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, May the 1st. Catch you tomorrow with the latest from the FOMC. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.